Hi, this is Professor Arujo. We're going to be looking at Chapter 1. This is the slideshow that comes with the text. I'm going to go ahead and make a few notations on this and give you some pieces of information that I think is important. So Chapter 1 has 3 objectives. The first learning objective here looks at the forms of business and who uses accounting information. The second objective looks at 3 principal types of activities that you need to become aware of. Again, this is an introduction. You'll get to know them significantly over time. And the third objective is the heaviest objective in learning in Chapter 1, because we're going to be looking at, actually, we're going to focus on 3 of the 4 financial statements and how they are prepared. And that preparation takes a long time. So this is a time-consuming class because many of the things that we're doing aren't so difficult. They are just super time-consuming. And so that's why I mentioned it in the introduction, that you're going to need to put some time into the course to pass it. So if you're interested in starting a business, and a lot of people are, a lot of students are, one of the things that has to be talked about up front is the form of business organization that you want to start. You have 3 options. Well, most people have 2 of the 3 options anyway. If you're alone, if you're doing this all alone, you can be a sole proprietor. It's the easiest thing to do. But you can also incorporate yourself. And so you can actually become a corporation. The business end of what you do can be a corporation. And those are the 2 choices you would have if you were doing this solo. If you wanted to go into business with a partner, or 2, or 3, or 4, or what have you, then you actually have 2 choices as well. You can be a partnership. It's relatively simple to establish. There's more heads involved, and certainly more talent, you would hope, and more money. However, you can also decide to incorporate yourself, become a corporation. So those are some of the options you will have if you decide that you want to go into business. This is one of the first questions you're going to have to answer. There are a lot of users of information inside the business. So there's internal users that we're talking about. And this book, by the way, looks at things from the corporate perspective. So we're going to be looking at everything you're going to be learning in this course is going to be from the corporate perspective. Okay. So the internal users of financial information from the corporate side include the folks in marketing, include the folks in management, include the folks over in human resources, and of course those that deal with financial aspects of business. So, and this is one of the reasons why you're required to take an accounting course, regardless what your major is going to be in business. You may not, never, ever, ever want to be an accountant, but guess what? You might want to go into marketing. You might want to manage. And sure enough, the accounting information is going to be sitting there in front of you. And so it's incredibly important that you learn it and understand how to read it, because it's going to be critical to whatever function you want to play in business. So in the marketing department, they have a very important job to play in accounting, because marketing supports price. And the prices that are paid by the customer to the company is the revenue of the company. And everything, as you'll see, starts with revenue. Revenue is the most important thing. Selling your goods or services, whatever you're selling, to people is how you make revenue. And so you can't sell anything without having a price. And oftentimes it's the marketing that provides support for that price. So whether it's always low prices at a place like Walmart, or always high prices, $1,000 for a phone at Apple, you need a strong marketing background and an understanding of why it's important to the financial part of the company to understand why price plays a role. if you're in management, you're going to be using those numbers to decide, in this case, which products to keep, which products maybe to stop. A lot of companies are doing this now as they declare bankruptcy. They're really seeking to close certain stores that are unprofitable and deciding, which stores to close, which stores to remain open, and how they reorganize is really going to be a bottom line decision. They're going to look at the numbers. And, if you're not making any profit at the store, say in Poughkeepsie, but they are making a profit in the store, say in White Plains, well, they're going to close the Poughkeepsie store and keep the White Plains store. So management's going to make those decisions based on financial information, based on numbers. And so it's important, again, these are internal users of accounting information. Super important that they know what the heck's going on. On the bottom there, you have human resources. And of course, human resources play a very important role because the biggest expense for all service businesses, so businesses that are in the service industry, like hospitals, for example, most of their expenses are employee related, pay, benefits, things like this. And so human resources has an incredibly important role to play with the accounting information, with the financial information, because they have to make sure that the company gets people that can get the job done, can compensate them and give them decent benefits, yet without sacrificing the fact the company needs to make a profit. And that's tricky. That's very, very tricky. And so again, even in human resources, they're looking at the accounting and financial information. And of course, the finance department is listed there as well, as sort of an obvious thing. Yes, they definitely use financial information for a number of different things. Here your book says, well, if we wanted to share our profit with the owners, which is what a dividend is, can we do that? Do we have enough cash to pay them? Do we make enough profit to pay? So there are also external users. So as someone who's an external user of financial information is someone who is outside of the company. And you kind of have to understand that there are a lot of people who want to know what's going on in various companies. Well, the only companies that are required to actually disclose their financial information to the public are something called public companies. You'll know a public company because they'll have shares of stock to offer on the stock exchange. And so if you can buy a share of stock in a company as just an average Joe Schmo in the public, then it's a public company. But there are many, many companies who are private corporations. You cannot buy ownership in a private corporation if you're just a general member of the public. And so the financial information for private corporations are not disclosed. But nonetheless, we are looking at things here from a corporate perspective. And in this case, we're going to be looking at and emphasizing what public corporations do, which means you and I are going to be getting financial information, and we are external users of that. Of course, investors are listed twice here because I guess they're twice as important, or at least they like to think they are. And so investors would be looking at financial information because, is the company earning a profit? Is the company growing over time? Is my share of ownership more valuable today, or will it be 5 years from now than it was 5 years ago? So investors want to see the information themselves and make those types of judgments. Creditors, the word creditor, by the way, simply means a lender. So in any case, creditors make a very important important impact on corporations because every business needs to borrow money. It doesn't matter what size of the business, small to all the way very large. They're all borrowing money for various things. And so a creditor is someone who lends money. And a creditor wants to know, of course, the financial information because they're not lending these companies money so they can just take it and run. They want it back with interest. That's how they make money. And so they're going to want to know what the financial information says as well, so they can make better decisions for themselves, whether they give a loan or not. Okay, and there's some very good information here to read. I'm not going to teach you ethics. I think we all brought up with a sense of right and wrong. And it's nonetheless, all these financial scandals happen to people who, just like you and I, had a sense of right and wrong, whether it was we learned that from our family, we learned that from school, from churches or synagogues or mosques, or a philosophy that told us we should be honest and be good and contribute. We've all learned that. But yet it doesn't stop people from making mistakes. In some cases, huge mistakes that create financial scandals. And so the portion of this chapter that deals with ethics really looks at, how important it is to be honest, when dealing with financial information in particular. Remember, our entire economy is based on financial information. The stock market, the bond market, all run on financial information. When you and I need a loan, when we want to start a business, it's based on financial information. So if the financial information is not honest, or as honest as it can be, you can't have a system that's based on that, because everything needs to be based on trust. And so this is where the ethics comes in. Corporate accounting scandals have been widespread. They'll continue to happen, no doubt. But there have been some big doozies in the past that have resulted in many cases, stockholders and employees losing everything as the company went down. So Congress actually passed a bill that was signed into law by President George W. Bush that actually made it a crime for the very first time for corporate executives and certain members of their boards to lie about their financial issues, with real jail time, real penalties that are involved. And overwhelmingly, this is a very good development in our history because of the importance financial information means to our entire system. Okay, so you'll read up a little bit more. There's more on Sarbanes-Oxley in chapter 2. Okay, and so basically every learning objective ends with a do-it exercise. In our case, the do-it exercise, the solutions are given to you both in the book and in the slide. But these are things that are important to review before you go ahead and do some of your homework, because some of the homework is going to be very similar to this. Okay, we're going to go ahead and look at learning objective 2 as well, and I'll make a separate video for objective 3. So learning objective 2 looks at the different types of business activity. There are 3 principal types of business activities, okay? The first one that they talk about is financing activities, and I think you need to understand the word financing, right? Because it comes up pretty simply all the time. If you and I want to buy something that's pretty large, like a car, it's a large purchase for sure. The question is, okay, how are we going to finance the purchase? In other words, where are we going to get the money to buy the car? And that's basically what financing activities are all about. So for you and I, simply, we could probably have some of our own money, right, saved to put down on a car. And we might need to borrow the rest from a lender, from a creditor. And so the financing is a combination of what we call equity, what we own in the asset, and a liability, what we owe to a lender. And so financing activities for businesses are usually involving what the owners have put into the company and what the company has needed to borrow from its creditors to get money. Investing activities it's different than personal investing. When we talk investments, many people just go right to, oh, you're going to buy stocks, bonds, or mutual funds. Well, yeah, that's an investing activity. But from a business perspective, if I'm a pizzeria and I own a whole bunch of stocks and bonds, it's doing nothing for me in terms of helping me sell more pizza. And that's my business. My business is to sell pizza and related items. And so it's nice that I can invest in stocks, bonds, and mutual funds of other things, but that's not the type of investing activity that's going to help me as a business. So what type of investing activity would help me as a business? Well, if I perhaps bought a delivery truck, right? Because now I could make a lot of pizza and now I can actually deliver it to customers. Will that help me sell more pizza? Yes, it will. Maybe I need more efficient ovens, right? So I can actually cook more pizzas in my oven or even more quickly. So less time to bake those pizzas. So the oven would be a very good investment for my business because I'd be able to cook more pizza. And if it took less time because it's more efficient, I'd actually be able to sell potentially more pizza. So all of those, that would be an investing activity. So we're looking at investing activities overwhelmingly. From this perspective, we're looking at purchasing assets for the business that help us sell more of whatever we're selling. Okay, so I just focused on the pizzeria as an example, but we can all understand that purchasing a truck that we can deliver pizzas to customers would help us sell more pizza. We could understand that purchasing that oven that's more efficient and potentially can have a lot more pizzas in it will help us sell more pizza. That's an investing activity. And so that's what we're going to be focusing on in this case. The last activity happens all the time. These are operating activities. And the word operating, you need to look back at the issue of what are your operating hours? Right? In other words, when are you open to do business? That's when you're operating. Some businesses operate 24/7. Amazon is always open. Hospitals are always open 24/7. There's no holidays where they're closed. But a lot of businesses, they open at 8 or 9 in the morning and they close up at 7, 8, or 9 at night. Those are the hours of operations. So what happens in those hours are operating activities. So what happens in those hours? Well, only when the business is open can you sell stuff. And so you are collecting revenue from customers. And so any type of selling of goods and services that give you revenue is an operating activity. Of course, when you're open, usually it's when you're also paying your bills. So you're paying your rent, you're paying salaries and wages, you're paying other types of expenses for the business. And so expenses also are operating activities. There may be a couple of other ones that are involved there, such as, if you are a retailer, you're going to need inventory. So you might be receiving and stocking inventory and so forth and so on during those times as well. You're also going to be paying some of your bills, and you're going to be collecting some money that's owed to you. So there's certainly all of those types of activities are what we call operating activities. Okay. And of course, your book just sort of gives you examples. Again, in the financing area, borrowing money, creditors is a liability. When you're raising money, corporations raise money by selling shares of ownership. That's all stock is, a share of ownership, for cash. The owners put cash in, the owners get shares of ownership. And so those are types of financing activities that your book talks about. Investing activities that your book talks about, really, I focused on the purchase of resources, the purchase of assets that a company needs to sell more of its stuff. And that's really, really important. So it tends to be big ticket items that are going to be lasting a long time, that are in the asset category because the company owns them and uses them, right, to deliver its products or services. Certainly it does include traditional investments, but again, if I'm a pizzeria and I own stock in another company, that doesn't help me sell more pizza. And ultimately, that's how I make a profit. So that's why we're looking at investing activity from a specific perspective from assets. And then, of course, your operating activity, because your book looks at anything in which your business is operating. What happens when your business is operating, when it's open for business? Well, you're selling stuff, so you're collecting revenue. Revenue is what you collect when you sell goods or services to your customers. You're taking up inventory. You're collecting money that is owed to you. That's called accounts receivable. And of course, you're paying all your bills, the costs of running your business. Those are expenses. And so basically speaking, these are operating activities. Okay. We're going to be talking about the net income and net loss piece in objective 3. But basically, that's objective 2. The do it exercise at the back of objective 2, again, gives you an example of what an activity might be and asks you to solve what that could be. So if you're renting something, rent is an expense. So it's an operating activity. If you bought a truck is an asset. So it would be an investing activity. A notes payable meant that you borrowed money, which is a liability, which would also make it a financing activity. If you issued shares of ownership to your owners, the owners are putting money in exchange for shares of ownership. That's called common stock, it's common shares. That's a financing activity. And of course, if you sold anything from providing a service, that's revenue, that's an operating activity. And that's where we're going to stop today.